Hello and welcome to our May 2026 Outlook and Positioning video. My name is Derek Varner. I'm here with my friend and colleague Mike Allison. We're going to talk about what's happening in the market, in the economy, how that's influencing portfolio positioning for clients. So, without further ado, we're excited to share with you these updates. Mike, how are you? Welcome. Thank you for joining.
Yeah, it's great to be with you. Looking forward to it.
So let's begin with performance year to date across a variety of asset classes. And if you watch the news, most of folks are would maybe assume that markets are down year to date because of all the consternation and the conflict in the Middle East and the war in Iran. Encouragingly, we've seen lots of different asset types move higher. So things like the S&P 500, as we know, which is the 500 largest U.S. companies, up about 6% through the end of April. We show an equally weighted version to try to normalize for the fact that some companies are larger than others, and just to give a sense of how the average S&P 500 company is performing. That's up even more, about 7%. But what's very encouraging is we're seeing other asset types like dividend stocks, smaller companies, which tend to be more economically sensitive, doing well. So maybe a sign of expectations for higher economic growth, and foreign markets, places like Europe and Japan, up about 6% as a basket, and then emerging markets. So areas like China, India, South America, up about 15%. And then lastly, commodities, which may not be a surprise because this includes things like oil and gas, which are obviously higher this year, but other things like gold and industrial metals, agricultural commodities. So, Mike, help me and our viewers make sense of all this. Why are assets doing so well in 2026 when it feels like there's a lot of things to be worried about?
Well, I think it's healthy when a market climbs a wall of worry. I'd be worried if no one else was. And so I think that, the driver of good market performance is generally corporate earnings over time. And I think we've had a very good earnings backdrop for Q1 earnings reports and outlook for the rest of the year. I think there was some initial fear that, the events in the Middle East would sort of immediately lead to economic weakness. And I think that, we haven't seen that, and managements and their outlooks are not seeing that. I think there's at the margin some worry that we might have an uptick in inflation from recent levels, and that's possible. But for how long, it remains to be seen how long the events in the Middle East continue and what the knock-on effects are. But I think at the end, corporate earnings are what drive markets, and economic growth helps drive corporate earnings. And so we still have the AI spending and CapEx story, which is driving, the larger cap names. And I think, the stronger dollar recently is a function of, higher energy prices and that sort of thing. So we'll see how that all nets out. But I think one of the things is just the healthy backdrop of concerns over macro. But when you get down to the micro, company by company, the economy and corporate earnings are pretty solid.
Yeah, well said. So, let's go to earnings next because we've had a real sort of gangbusters earnings season. But first, I want to just quickly for the audience remind everybody good old investing principles of just staying invested for the long run, despite the potential headlines that are out there, which tend to be always there's always something to worry about. But we've gone through one of the best months in the stock market in the last several years. And when we look back historically, we see that, all these types of events, whether it's geopolitical, whether it's wars, natural disasters, you name it, pandemics we've been through a lot, financial crises, markets tend to move higher in the long run because of, uh, in the near term, it's corporate profitability, and in the long term, it's economic growth and innovation. So we try to advise clients to stay focused on their long-term investing goals, and we with them help to build portfolios that are suitable for trying to achieve those goals and also balanced across lots of different asset types. So not just the S&P 500 or the Dow Jones or those indices that may be seen on the news each night. So let's go to earnings next. I think that's a good place to go, Mike, since you touched on it. This has been just really surprising in a good way. and no pun intended, but the earnings surprise for the first quarter, which we're going through first quarter earnings reporting season now. As of May 1st, we have about 315 S&P 500 companies that have reported earnings, and the earnings surprise is almost 21%. So what that means is companies outperformed Wall Street expectations or the consensus expectations going into earnings season. So that's really, in a nutshell, why a big part, I think, or we think, why the market has moved higher in 2026, and particularly in the month of April and into May. Just really gangbusters earnings and outperforming what was already kind of baked into the market. So, Mike, are there any companies that you sort of noticed or observed, or any kind of key trends from earnings season that you'd call out? I have a few too, but I want to give you some space to share.
Yeah, I think, a lot of the earnings growth and surprises, were in technology and energy, obviously. One of the things that I'm encouraged by, kind of two things, I suppose. One is the healthy revenue growth that we've seen. Sales growth in general was really strong. And by and large, across the board, there was a little weakness in less strength, I should say, in healthcare. But by and large, really strong revenue growth, which is really good to see. And then I think, margins, earnings margins or profit margins are also really strong. And I think that's where we were seeing the footprint of, productivity gains from AI, for example, as it starts to proliferate through the economy. So I think those are the very encouraging takeaways, revenue growth continuing to be very strong, and earnings growth driven by not only revenues, but also margin expansion.
Yeah, that's well said. And when we look across the different sectors and types of companies, you can see the surprise was fairly broad based, as Mike said. But some of the big standouts were in consumer discretionary and communications. Now that may be a little bit confusing on the surface, because consumer discretionary includes lots of different types of companies, but one of the ones that really drove earnings this season was Amazon. And then on the communication side, it was Google and Meta, or Facebook. So you have three companies that are not, they're not categorized as technology, but at the end of the day, they're really technology companies. So we're seeing these very large technology or quasi technology companies just continuing to make more and more money, surprising Wall Street with their ability to earn. And they're still investing heavily in capital spending, as we talked about previously. So they're making more money, they're investing in future opportunities. So that has been a key driver of the market, but it is a source of potential risk or caution that we've talked about in past videos, that a lot of the earnings growth, a lot of the economic activity, a lot of the capital spending that's happening in the economy now is concentrated in the tech sector and a handful of those largest companies. So just something that we're mindful of, but at least for the first quarter, just it continues to be a train with a lot of strong momentum. So now I want to cover, as we always do in these videos, our dials. We did make one change this month. We moved the economy dial one notch higher. We still list households as negative, but we have seen employment continue to be relatively stable. We've seen growth be relatively stable. We are concerned about households with respect to inflation and just household sentiment and fatigue about inflation. But at the end of the day, folks are still spending. And what we've seen is they're spending more primarily because of higher tax refunds and continued sort of wage gains and employment gains. So we moved the economy dial to one notch higher, from slightly negative to neutral. Financial conditions, this is one where we're still cautious, particularly because of inflation. I think the war in Iran obviously has caused energy prices to creep up, but it's also caused the prices of lots of other things, other commodity types, agricultural inputs and outputs, to creep up. And I don't know, when that ends, and if we've seen the worst of it, quite frankly. So that's an area that we're a little bit cautious, and that's going to cause the U.S. Federal Reserve potentially to have to be slower in reducing interest rates, and that flows through to things like mortgage costs and auto loans and all those things. We haven't seen a lot of stress in credit markets, which is good. So in other words, banks are lending and they're lending at relatively modest spreads. So, in other words, we haven't seen a big increase in the risk premium that banks are requiring to lend, which we typically see during periods of economic stress. So, financial conditions, I would say maybe a little bit cautiously neutral there. And then on the market side, we talked about earnings just really, really driving the market higher. Valuations look a little bit either fair or extended, depending on the part of the market that you're observing. So in that dial, we're still neutral as well. But Mike, what are your thoughts on any of these dials, or where you see things trending for the rest of 2026?
Well, I think barring any exogenous event that has yet to come to pass, I think we're likely to see a continuation of good corporate earnings and, good economic growth. I think at the margin, a lot of this increase in inflation may already be here because of, higher gas prices at the pump, for example. What we haven't seen, which we may see later in the year, is, increased in an acceleration in the rate of inflation in food prices as the planting season and where there's shortages of fertilizer or the commodities that go into the making of fertilizer based on the closure of the Strait of Hormuz. So there's some sort of knock-on effects that we may yet see. I don't think we've seen yet, but I think we've probably seen the worst, unless something new happens. We've probably seen the worst in terms of the price of oil, in my opinion. Doesn't mean it'll come down, but it's it could be near to intermediate term peak.
Well, let's hope you're right, and let's hope for a peaceful resolution in the Middle East. And thank you everyone for watching this month's video. As always, this is meant to be a high level summary, but if you'd like to get into greater detail, please just reach out, contact us. We're happy to discuss these ideas with you in greater detail or discuss your specific portfolio. And then accompanying these videos, we also include supplemental materials that walk through these ideas in greater detail. So thank you again for watching this video, and thank you for your trust in our management of your wealth. And Mike, thank you for joining me once again this month.
Great to see you, Derek. Thanks, everyone.
Okay, thank you.